Time for top picks from Stan Wong. He's taken your questions all show long, and it's now time for his top picks. The first top pick, Stan, the iShares S&P TSX Composite High Dividend Index ETF, ticker symbol XEI on the TSX.
Paul, certainly one of the longer name ETFs out there. So XEI is a name that I've held in the portfolio for some time. I continue to like it. It's basically designed to replicate the performance of the S&P TSX Equity Income Index. It gives a great opportunity for investors to purchase strong dividend income names from established Canadian large cap companies. You're getting about a 5.2% dividend yield. You've got banks, pipelines, utilities, and telecom stocks in there. Some of the top names would be Royal Bank, BCE, Enbridge, TD Bank, and Pembina Pipeline. This particular ETF is still down about 15% from its highs earlier this year. I think it's an attractive entry point. You're getting that 5.2% dividend yield, which is expected to grow over time given the names that are in there. And the expense ratio is fairly low at about 22 basis points.
Okay. Number two, ExxonMobil, the giant of the international oil sector.
Sure. So one of the largest names in the world in terms of energy companies, forecasted to gross over $425 billion in revenues for 2022. We've talked about energy, and I've mentioned how many times that I like the energy space. Exxon's portfolio includes more than 18 billion barrels of oil equivalent of proven reserves across 15 countries, so a very well-diversified, large portfolio. The downstream operations represent about 80% of Exxon's total sales, so downstream operations would be more stable than the upstream side of things. Free cash flow yield is very attractive at about 12% for Exxon. Like many large cap global energy companies, Exxon has really been focused on returning excess cash to shareholders via share buybacks and dividends and so forth. And they're keeping capital expenditures and production increases in check. Earlier this year, Exxon's management announced a tripling of its share buyback program, bringing the program to $30 billion US. So definitely a shareholder-friendly type of approach. Again, broadly speaking, I like energy. I think energy prices are expected to remain firm over the coming years, given the steady global demand, very low inventories, and industry-wide underinvestment. You're getting a 3.7% dividend from Exxon, which we expect to increase over time as well.
Can the share prices of big energy producers move higher if crude oil stays at where it is, which is at about $85 or $90 US per gallon for West Texas Intermediate crude? I ask the question because the energy stocks have come off sharply during the period where WTI has come down from about 120 US dollars per barrel to the current level.
I still see energy prices as being undervalued relative to the current levels of WTI, even at $82, $83 at this point. So I think investors in general, the market in general, has a fear that these oil prices are not going to remain firm over some time, but we think that oil prices will remain firm over time. And really, there's really a major demand-supply imbalance out there. There just really hasn't been any investment or capital expenditures, and we continue to have more and more demand from around the world. Slow down or not, we're going to have more demand in 2 years, 3 years, 5 years time, and going to a green economy or green environment is not something that can happen overnight.
Okay. Finally, top pick number 3 on this day, United Health Group, ticker symbol UNH on the New York Stock Exchange. You told us at the top of the program that you like the healthcare sector, and here is a name in that group.
Yes, I like the healthcare sector because it gives you that combination of defense and offense. The United Health Group has done very well for our clients. We continue to own it and continue to buy it for our new clients. We're looking at about $322 billion US in forecasted revenues. It's the largest managed care and private health insurance provider in the US. They have 50 million members across the US and in their international businesses. Their strategy of providing medical insurance, pharmacy benefits, and healthcare services creates that synergy and a very strong value proposition to its customers, and therefore it's going to have very steady and reliable sales as it has in the past. Last quarter, management reported earnings that easily beat Wall Street expectations, and they raised their earnings guidance for the full year. We expect annualized earnings growth for this company to top 12% over the next few years. You're getting a nice, modest 1.3% dividend, but that'll grow over time. Really, for me, it's a bit more of a growthier name rather than an income name.